Okay, that was of course Mr. Rakesh Jhunjhunwala, and according to him, the bull run has already started. And if you guys have been so far on the sidelines, well, now's the time to jump in then, if Rakesh Jhunjhunwala of course is to be believed. One way of course of doing so is mutual funds. And within mutual funds, NFOs, because mutual fund houses, like I mentioned, have been flooding the market with that. Like I mentioned, at least about 10 NFOs is what I have seen. Axis has come out with quite a few NFOs, so that's pretty interesting. I also do see quite a bit of NFOs by Mahindra among many others. So let's bring on board Harshvardhan Roongta of Roongta Securities to talk about all of these. Harsh, thanks so much for joining us today. You know, interestingly, all of these new fund offers seem to be across categories. It's not just, let's say, towards large caps or large and mid caps, etc., which by the way are seeing quite a bit of traction. Let's start off first with your view of all of these NFOs. Do you think that there have been quite a few that have entered the market? Are they indicative of perhaps mutual fund houses as well optimistic of a recovery?
I think, Mobina, that coming out with more number of NFOs means that mutual funds are expecting a recovery in the market or anything of that sort. Essentially, if you notice, I mean, in the year 2017, about October 2017, SEBI had come out with regulations regarding the categorization and rationalization of mutual fund schemes. So as a result of that, the effect, when the mutual funds, the AMC started giving effect to that circular, many of the schemes were merged because there was found that there was duplication of schemes with the same objectives. So all those schemes were merged into one scheme. This also created a vacuum in some of the AMCs. Like for example, somebody say probably did not have an arbitrage fund in their category, in that offering of a basket of offerings. So now over a period of time, all the fund houses will come out with different kind of NFOs to fill that offers, the basket of offerings that they have for the investors. So I think, essentially I would like to read this development as a situation wherein the fund houses are actually filling up all the categories that have that they don't have a product in already, as per the definitions by SEBI.
Okay. Now, Harsh, when we say an NFO, it's basically the first time that a product is being launched. It doesn't have any sort of history. And the tendency for a lot of our viewers is to just look at the track record, right? And I think that's the right thing to do too. What's the fund performed like? I know past returns is no guarantee of future returns, but nevertheless, the tendency is to look back as to how this fund has done. So what should be then some parameters by which one can judge an NFO, because that element is not there?
You're absolutely right, Mobina. So the question arises now, if there is a particular AMC which is coming out with a new fund offer. Now, as I said, there could be a situation wherein they're coming out with this NFO because they want to complete the basket of offerings that they have as per the SEBI categorization rules, so that investors looking to invest in any category of schemes, they should have that option available with every fund house. So that probably is the option, is the reason why you see so many fund houses coming out with different NFOs. Now, with regards to your question as to what should an investor look at, so you're bang on right when you say that if there is an NFO, say for example there's an NFO in a small cap category. Now, if an AMC is coming out with an NFO, of course there is no track record to evaluate how this fund has performed across different cycles. At the same time, you have several other mutual funds offering you a small cap fund which have been in existence for almost 20 years now. So you can judge the performance, you can follow the you can follow how they have performed in different market cycles. You can look at the entire basket of, how the portfolio has been churned around, what's the turnover ratio. You can see all of that and take a decision when to invest or not. So the first first point that I would give, as a reference point for investors looking to invest in NFOs is what is unique in this particular offering. So if there is a new fund offer coming out, how is it different from something that is already available in the market with a track record? So if there is some unique benefit that is coming into picture, then of course you will try and look at it because there is no other precedence. And if there is some, if it's similar to something that is already in the market, most naturally you're inclined towards going and trusting somebody who's already performed across different cycles. So that of course is the first category of parameter to decide as to what should you and why should you look at an NFO. Now, having said this, now there is one confusion that we'll always come across, and that is every scheme, whether it was introduced 20 years ago or coming out today, at one point in time, every existing scheme was also an NFO. So, had everybody thought similarly and never invested in any NFO, we would not have any existing schemes also for that matter. So, coming out with an NFO, offering an NFO by itself is nothing wrong. It's just a starting point for that AMC in that particular category to come out with a new fund offer. So this brings to the second parameter that you can consider. It's not that you should not look at it at all. Just you have to understand that there is a reason it is a first offering, and over a period of time it will become an existing scheme. Then how do you decide if it's similar? For example, there is a small cap fund. Now there are already a whole lot of small cap funds in the industry. So then if somebody comes out with a small cap fund, what should you look at? So in that case, I would say you should look at the AMC pedigree. Which fund house is making an offer with a new scheme? How have they managed all other schemes that they have? So suppose they're offering a 15 different equity schemes or a combination of hybrid and equity schemes, then you have to evaluate how they have performed across all those schemes. As an average, have they outperformed in most of their schemes, or it's only one or two schemes that have done well? That goes on to give you an idea about the pedigree of the fund house. If they've done well generally across different schemes that they already have, all likelihood they will do good even in the small cap, a new fund offer that they have in the small cap. So uniqueness, what is different in this particular NFO? If you don't find anything different, you can, and you still wish to invest, if you trust the fund house, they have done well for you in other schemes, then of course there is no reason for you to not look at why a new fund offer should not do well for you. So these are two parameters. You have to draw a very delicate balance between the two, and then of course evaluate whether you want to invest in it or not.
Okay, understood. So that's essentially some parameters by which perhaps you could evaluate a mutual fund. So Harsh, among all the NFOs that have been announced, is there anything that's catching your attention? Of course, it'll also depend on an individual, the number of equity funds they have, the number of debt funds, age, etc. But any NFO that's essentially catching your attention, which is ticking the right boxes based on the parameters you mentioned earlier?
If I just have a look at whatever is available right now, I don't really see anything being, tick marking the characteristics or the parameter of uniqueness that we spoke about. So all kind of funds are available in the industry because we are reasonably, a couple of decades down into a mutual fund industry. So everybody somewhere has some offering to give. So there is no uniqueness per se that I see in the current offerings that is available right now. However, if you, as I said, on the second parameter that we're talking about, which is the pedigree of an AMC, and if they're coming out with something, there is a possibility they may do well in that particular category. I would only see, if I have to really pinpoint it and put my finger at something at least for the sake of understanding purposes, then I would say Mirai Asset Management has come out with an arbitrage fund. So that is something that you could look at, because within the arbitrage category, I mean, it's a simple product in that sense, in a literal sense, not specifically mentioning that there is no expertise to be put into it. There's a lot of expertise to be put into it. But in any case, arbitrage fund could be something that you could even start with as an NFO with a fund house that such as Mirai, because they've done well across their equity schemes even otherwise. So even if I have to pinpoint at something, I would say a Mirai arbitrage fund. However, you need to be careful about the spreads that we have in arbitrage as an opportunity right now, because that will continue for the next 2 or 3 months. So you might not really see too much of gains in this particular product because there is not much of spread in the arbitrage opportunity that we're looking at. So this is something that I would say at this point in time. One point of caution that I really want to emphasize upon is we have seen many industry intermediaries, like distributors and even investors falling to that call of NAV at 10. So you're buying NFO, it's available cheap with an NAV of 10 rupees. Well, that is not something that has any relevance to it being available at a cheap price. So NAV 10 rupees is much better than another existing product which has a 40 rupees NAV. So just one single point of extreme caution that I'd like to leave with your viewers and even request the intermediaries is not to push this NFO or buy this NFO with a logic that 10 rupee NAV is cheap, so please buy into it and don't look at existing products which have a 40 or 50 rupees NAV.
All right, understood. So that's essentially what Harsh is recommending. One of them is, at least among the NFOs currently, the ones which are being proposed, the Mirai Asset Arbitrage one is something that is catching his attention. Though, mind you, it depends as well on several factors, interest rates, etc. Arbitrage, remember, tries to exploit the opportunity of differences in pricing. A bit complex, but yes, that is something that is catching Harsh's attention. Okay, let's do one thing. Let's take on board questions and queries then, and our very first query is coming in from Joseph George. Now, Joseph is writing into us saying that he is an absolutely new investor in the equity markets, and now he wants to know that in order to start off, what are the best names to buy in this market correction to build a portfolio accordingly, the investment capacity of 2 to 3 lakhs for long-term growth over 6 to 8 years to get a good return on investments and capitalize the opportunity, because he personally believes markets could go to 2007-2008 levels. So essentially what he wants to do is he wants to start investing in the equity markets today to be able to capitalize on the opportunity, but he's saying he's an absolutely new investor, never invested in the equity markets. Harsh, what would you advise him in terms of dabbling in individual stocks? How would you advise him in starting off his investment journey?
Well, Mobina, you and me both are aware of the fact that it takes years and years of study and experience in the equity market to really be able to understand and identify those companies which are likely to do good in the future. It takes years and years of study and experience. Besides that, another important point is to be able to identify a company. That's not only important, but also to buy it at the right time. Now, I think anybody is try and guess that how can you do both of this together at a point in time when, especially when you're a new investor. So my suggestion to Joseph would be that if he's starting his investment journey, it's better that he entrusts his money to professionals who have been in this industry for a long time and have been managing money as a full-time profession. So mutual funds, of course, land up being the first choice for him as well. Now, how does it serve its purpose? I can explain that as well. So if he entrusts his money to fund houses, they are anyways, as a full team, the entire fund house has its research team which are basically trying to identify those companies which are likely to benefit and what's a good time to buy. I wouldn't say the right time, but a good time to buy these couple of stocks. So that purpose gets solved for him. The other risk that is there in equities, of course, the volatility and which companies, which sectors are likely to do well. So a well-diversified fund, for that matter, invests into say about 30 to 50 companies. So in any case, you will diversify your money across different companies so that risk gets mitigated and gets reduced when it is spread across different companies. So a good starting point for Joseph would be, because he is also a new investor, to go into passively managed funds. So index funds would be a very good option to start with. He could either choose a Sensex fund which has a basket of 30 companies or a Nifty fund which is a basket of 50 companies. I can name the schemes for him as well. HDFC Sensex fund or an IDFC Nifty fund. These are the options that he can choose, and he can even split into the two, and if he wishes to, because the amount that he wishes to invest is about 5 to 6, 2 or 3 lakhs. So he could even split it in case he wishes, though it's not really required. And going further, as he understands, because he's got his money involved already, he will be certainly tracking and trying to understand the market. So going further, as he gets more experience and gets more comfortable with the volatility in equity, then I think he can dive into actively managed funds and also buying equities directly if in case he wishes to do that.
Okay, so that's some advice coming in from Harsh. Joseph, how you can start off in this journey in equity markets, but it's good that you're at least taking the first step, and Harsh's advice is coming in right now. All right, next query from Darshan Vishnu, who says, I am 24, salaried, looking for investments in safe tools to yield returns in the long haul. He also says that he doesn't want to lose any money, but at the same time get returns which in the long term result in an accumulated fortune. At present he has some moderate investments and endowment policy as well as going on, and he is open to investing 6,000 to 8,000 every month. Harsh, it's a dream, right, where you have absolute safety of capital, at the same time you're getting return which will help you in generating a fortune as well for the long term. So Harsh, luckily Darshan is only 24, he's very young, he's got time on his side. How would you help him start off?
Absolutely right, Movina. So the question is, if you're looking at a product wherein there is a 0% chance of you losing any money, then the options available to you are those fixed deposits or certain categories of debt funds where they're very on a safer side. Now you have to remember, if you're investing in say fixed deposits, for example, or any fixed return instrument, there is an it's unlikely that you will beat inflation. So creating wealth is a far-fetched thought. Beating inflation also would become difficult in that sense. And in case you're looking at generating higher returns, then you have to take some kind of risk. There is no way you can take an absolute safe investment and create a fortune for yourself as well. What you can do most certainly is, if there is risk involved, there are mechanisms available where you can reduce the risk. You cannot eliminate risk, but you can reduce the risk. So if you're talking about investing in equities, for example, which you believe over a long term will help you actually create wealth. But investing in equities comes with their own set of volatility. So what do? You choose an SIP route wherein you will invest every month. So irrespective of where the market goes, you're investing every month and you're taking the advantage of rupee cost averaging. So there is risk, but you're using a mechanism to reduce that risk. So that's the only way you can, aim to get a balance of both and try and create wealth for yourself. Now, since he wishes to invest about 6,000 to 8,000 rupees and he's only 24 years in age, looking for long-term wealth creation, I would suggest that he invest this money in an equity portfolio. I can recommend the schemes and the allocations as well. You can choose an ICICI approved Sensex fund in which he invests 2,000, an Axis Blue Chip Fund another 2,000, Canara Robeco Emerging Equity Fund 2,000, SBI Equity Hybrid Fund 2,000 rupees. Now he can create this basket with these 4 schemes of 2,000 each and continue investing into them irrespective of market cycles. And I'm reasonably sure over a longer period of term, he will not only beat inflation but create substantial amount of wealth for himself.
Okay, well, on that note, we'll not be able to take any more questions and queries. Harsh, thanks so much. It's always a pleasure having you on board on the Money Show and helping out our viewers. If we've not been able to answer your query, I know we're still getting a couple of emails from our viewers. Fret not. We're here on the Money Show every day at 5 p.m. to help you with your queries. So keep sending them in on the Money Show at etnow.tv. We promise to take it over the course of the next couple of days. Okay, well, meantime, let's analyze what mutual fund investors are